you know so much about the ins and outs of this stuff. Wilf was here yesterday. Did you see Wilf yesterday?
I saw Wilf.
You saw Wilf?
I saw.
He gets noticeably excited during earnings season for banks, whereas it's just a feeling of overwhelming dread when I know like 3 of them on the same day. We're going to be talking about
you got to look through them all quickly.
Just
and not
boring, complicated. He loves it.
Nice.
Answer me, do you get excited every quarter when that period
We try
is
to find something excited and also something meaningful for investors.
There you go. So it's for investors, so you need to be excited. You got 10 reasons or 10 things to consider for banks over the next year. And I just want to ask you about this first one. What do you mean? America first will drive large bank growth and performance in 2020. What does that? Make America great again? What is America first? Is that the Trump policy of nationalism versus globalism?
I love the question. And America has really driven our economy, and banks have benefited strongly. We think in 2020 you want to be more selective, and that means all boats aren't going to rise as they did in the fourth quarter. America first means on a snapshot of the largest banks, those who have 80, 90% plus of their revenue from the U.S. are going to do better because of the engine of the consumer. Bank of America, J.P. Morgan Chase. And probably a little less risk, Joe, and we'll get to this, to what could be a systemic risk over the next year or two, possibly in the capital markets. But I think America first is right. You have a lot of strategists who come on the show, and they talk about the underperforming developed markets outside the U.S., economies that are flat or down. U.S. is still growing. Banks are really benefiting in lending and being smart on investing in technology, and that's a story we don't hear a lot about.
It's interesting. So I like the top-down look at what's happening. So some of the risks. Latin America, you worry about it. That's your second point. Signs of recession, weak local currency. So if you have less exposure there, it's good?
It's good, and that flows into America first. It would have to be a big jump in the economy for Asia, and in particular, any offshoots from China. But I think in the U.S., the risks you got to watch are a couple. One, the oil patch in terms of banks cutting back from the shale drilling. Second, mortgages. Did you know that 85% of mortgage originations aren't the large banks? It's LendingTree, Amerisafe, banks we never heard of. And the third area really relates to liquidity. It's a big issue that we hear on the show. The banks are tightening up on leveraged loans, which feeds private equity for M&A. So overall, it's still a really good picture for 2020. We're staying with the consumer, and that gets you back to America first.
All right, for the consumer, you point out that credit cards continue to be a bright spot, but you may start to worry about credit quality. Why?
We're beginning to see an increase in terms of loan provision for credit cards. The U.S. household still today is healthy, really compared to before the financial crisis, not as leveraged. But we would expect that the loan provisions and reserves will go up. An area besides credit cards that could be more risk is auto loans. Joe, if you go buy a Ford 150 truck, 40,000 plus, you got 100,000 miles after 3 years, you get another truck, and then your loans roll over. Now it's 65,000. So again, it's these shadow bank areas. It's not going to be the J.P. Morgans that is the risk for our banking system.
The shadow banks, shadow banking area.
Yeah, absolutely.
Rates rise in the second half of the year. They start.
I think that can happen, and that would be a surprise on the upside.
Good or bad?
It's good. We were sitting here a year ago, and first of all, we thought rates were going to be coming down. You didn't want to own banks because 50% of their revenue was net interest income. Take it as a possible upside surprise. I think the operating businesses are good. We're talking about the consumer. But let's say in Q3 or Q4, we get an uptick in rates. That's going to really help.
Good news for the banks, not necessarily for the broader markets, though.
A broader market, because I also cover the housing market. So like a traffic light, I'm in the green area. If the 30-year fixed rate mortgage today at 3.7 to 4.1, yellow 4.1 to 4.5. We hit red, and it's negative for the consumer and the housing market. We get above 4.5 on a 30-year fixed rate.
We got to go out. We got something else to do. But banks avoid the presidential election spotlight. Why? Bernie Sanders or Elizabeth Warren, if they got elected, the whole banking sector would be at risk, wouldn't it?
Why be in the limelight? I mean, essentially, banks are.
What do you mean, why be in the limelight? So you don't worry about banks, you worry about other sectors have more risk during a presidential election year than banks?
I think there's always more exposure, drug pricing, pharmaceutical.
Drug pricing, pharmaceutical. But I would just think that Elizabeth Warren would be tough on banks.
Well, think about where we were in the Obama election, where everyone was punching the banks.
Right.
They're compliant. They're getting great return of capital. Okay. No reason to be out in the line.
So they're low risk during election year. Ken Leon, thank you.
Thank you.
All right. You work. So he's excited about banks. So I think it's endearing. I do. It's nice. Thanks, Ken. You're trying to help clients.